And so, without any further ado, please welcome Vito Torito.
All right, just a quick introduction. I'm Italian, so I do apologize for my English in advance. My name is Vito Torito, as Kevin rightly said. I've just received my Master of Science in International Finance, and I'm talking about asymmetric volatility this evening because this is the topic that I covered in my master dissertation. So I didn't put anything too complicated, so I avoided too many complex formulas and so on. So hopefully we can get started. This is what I'm going to cover this evening. The first part we'll talk about the theory and definitions, about leverage effect, about symmetric volatility and so on. We will see what volatility proxies are and what log returns are and why they are used to calculate volatility. Then we're talking about stochastic volatility, which is basically the main thing. I mean, this is the main topic of my dissertation. And we're talking about, we will see actually some charts that on gold, crude oil, FTSE 100 and euro versus dollar. Those are charts that have been calculated by myself using stochastic volatility models. We will go briefly through them later on. And then obviously just a conclusion to summarize what we found this evening. What the leverage effect is our negative returns seem to be more important predictors of volatility than positive returns. Large prices declines forecast greater volatility than similarly large prices increase. That's what Robert Engels said, is a Nobel Prize winner, and he won this prize because of his study on volatility. Another definition of this is volatility of stocks tends to increase when the price drops. This is a definition given by Black, who is the inventor, who is the professor who created the Black-Scholes model. In other words, the leverage effect is just a negative correlation between what? Volatility and returns. When the market drops, volatility tends to rise much more. Said in other ways, negative shocks usually make the volatility to rise more than what positive shocks do. Okay, we're talking about the magnitude. Okay, we're talking about market moves in percentage points. Okay, it's the last one, negative correlation between past returns and future volatility.
Can we like to ask questions?
Yeah, sure.
Is that across all assets, particularly focused on stocks?
We will talk about that later on, and yes.
Does that mean you can make more money in a falling market than a rising market?
It depends on which side you are. But yes, we will go through this. Yeah, yes, usually many traders, particularly option traders and futures traders, use this type of volatility in order to trade the market. Mainly, there are some volatility swap now, which are actually traded on Chicago Board of Trades. They're not very popular here in Europe, but it's very, very popular asset in US. Not at the moment, but it's spreading, let's say. Now, just a quick question for you. How many types of volatility do you know? Volatility? 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 Any other one? Okay. There are many different types of volatility, and obviously the measure of them is important in terms of trading strategies. Okay, there are they actually historical volatility over a specified period, but with the last observation on a date in the past. For instance, volatility calculated since January 2001 until December 2007. Okay, the last observation is in the past. Why is this relevant? Position traders are investors. That's the main volatility fluctuation they have to look at if they want to invest in a stock or derivatives, whatever it is. The next one is actual future, which is mainly the projection that you see over the internet. Volatility over a period starting at the current time and ending at a future date. Particularly, the future date is the option expiration date. I don't know if you ever came across the volatility smile. Is mainly a chart which explains how the volatility, the price action for an option since the beginning of the life of that option until the option expiration date. It basically tells you how the volatility fluctuates throughout the entire life of that option. This is very important for options trader. That's what they do all the time. Even futures trader now, because the futures market became really volatile, especially in the last 2 or 3 years. Implied volatility, this is probably something that you're really familiar with. It's the volatility calculated specifically using option prices, nothing else. You will, well, purely if there is an academic here in this hall, probably will say, no, that's not true. But believe me, that's the way it works in the real life. That's what they do in investment banks. They calculate implied volatility using merely the Black-Scholes model, which is not extremely accurate, in my opinion. We will talk about this in a further presentation, because otherwise we would be talking for hours about this. But implied volatility is specifically the volatility index, the VIX. We all know about it. That's the VIX, implied volatility, calculated on Standard & Poor's 500 option prices. Stochastic volatility, the most difficult one, is the tendency of volatility to revert to some long-run mean value. It's what Kevin was talking about. Basically, how to express this is, when we talk about volatility, usually in every single market there's an average value, okay, of the volatility. Usually it's about 20–25%, okay. It's like stochastic volatility works like an oscillator. If we talk about, for instance, the relative strength index, what we look at oversold and overbought, okay. When the price is oversold, what we're gonna do? Are we going? Would you go short or would you go long? Why? Exactly. It's exactly the same thing with volatility. When the volatility is too high, usually option traders tend to push it down. That's what they do. That's why it reverts to long-run mean value. That's why it's very important to know what the value is. Okay, it fluctuates on a long-run value. That's an average. It goes up and down, but at the end of the day, in the long run, it's always the same. It fluctuates within certain boundaries. It's up to a certain extent, it's very close to Bollinger Bands. More complicated than that, because this formula is extremely complicated. But you're right. The rationale behind the formula is almost the same. These models are the most popular one, especially in the academic environment. Gauge model, Gauge models, Chen model, Hessel model. The last two are extremely complicated. I'm not going to go through that now. We will talk about this maybe later on in a further presentation. Okay, proxy for volatility. Now this is a kind of new information for you. True volatility, believe it or not, cannot be observed. It's not possible to see what the real volatility for a stock, for a derivative, for a particular asset is, because it's very difficult to separate systematic variables from idiosyncratic variables. You look really crossed. In other words, it's very easy. Market-wide factors. Okay, it's very difficult to see if the it's very difficult to say if the market or the volatility is rising because macroeconomic variables, or because it's a specific news about a particular stock that you're trading. I don't know if you're trading, I don't know, Google's, for instance, at the moment. I don't know if you read a newspaper about China, what happened. Okay, so you can't really say if the entire macroeconomic environment, which is pushing up or down Google's shares, or it's because that particular situation which is provoking that particular movement in the market. That's why it's very difficult to say that. That's why we need a proxy. What is a proxy? Is a surrogate, something that can tell me how the volatility is performing roughly. Okay, obviously not, we cannot be 100% sure. We usually utilize log norm. Yes, sorry.
Yeah. If you go back a slide for a second. So, for academics, that's a worry, right? So whether it's market-wide fluctuations or whether it's ASYMMETRIC, for a trader, we don't care, right?
Obviously, that's obviously something that that's up to the trader. And actually, I was reading recently